Good morning, all, and welcome to SVN Capital's investor presentation and Q&A. I'm really delighted to have so many people joining us this morning. Today, Shree will be providing an overview of SVN with a focus on our holdings in India and why our access to the Indian markets provides a unique opportunity in today's investment landscape. This presentation is for informational purposes only and is not intended to constitute a sale, a solicitation, or advice. We do invite qualified investors wishing to learn more about SVN to reach out to me separately. We're always happy to connect one-on-one. As we hope this presentation and this session will be dynamic and informative, please feel free to submit any questions you might have in the chat, and we'll be sure to address them at the conclusion of Shree's presentation. We look forward to hearing from you. So we appreciate you taking the time to join us this morning. And now, Shree, I'll hand it over to you.
Thank you. Thanks, Jessica. Good morning, everybody. Thanks to all of you for taking the time to join this presentation, and thanks to Jessica for organizing this. Now, soon after releasing the mid-year letter in July, I left on a 3-week trip to India. I hopped around 6 different cities, met with a number of management teams, and came back in August. 2025 has been an interesting year so far, to say the least. Liberation Day, tariffs, wars in different regions. India in particular seems to be taking it on the chin. 50% tariff on India, the war with Pakistan, and the more recent H-1B visa issues. All this uncertainty is obviously showing up in India market. The ETF, India ETF, is essentially flat for the year, and even the currency is slightly down against the dollar. So I thought this would be a good time to give an update on India, which is now more than 20% of the portfolio. And then I'll follow it up with a brief description of my largest holding in India, which is Bajaj Finance. I'll use a few slides to be the guidepost, take about 15 minutes, 20 minutes, and then open it up for questions. So with that, let me get going. It's just a traditional disclaimer page. But before I actually launch into the India section of it, I thought I'll revisit the 4-part investment criteria that I use irrespective of the country I'm investing in. Primarily, I'm looking for businesses that I can understand. Number 2 is businesses that not only generate high return on incremental capital, but also high reinvestment opportunities. Businesses that are run by honest, competent management teams with skin in the game. And then finally, from a valuation standpoint, things that are trading at a reasonable valuation. With that as the backdrop, I currently have 11 stocks spread across 3 continents. I can go into some of the other details on the page later on if there are more questions. So the bigger question is, why India? Let me start with a little bit about the past. I'm originally from India, came here as a student, and have been here for more than 3 decades now. I've been running SVN Capital for a number of years, and at SVN, I run a number of different screens on a weekly basis. And there are a number of quality-driven screens that I have, and many India high-quality names had been popping up on those screens on a regular stream. So I reached out to one of the banks in India, and which in turn works with SEBI, which is the Securities Exchange Board of India, to get approval. And I got approved to invest in India last year. And so middle of last year, I've been slowly increasing the portfolio allocation to India. Currently have 4 different names, and one of them I'm going to talk about a little later. But back in 2022, Jenga Partners, based out of Scotland, DDIS, and he released this fascinating book called Global Outperformers. He was trying to figure out what are the markers for 10 baggers amongst various different companies spread across the world. Now, there are a number of other similar studies that are out there, but they seem to be more focused on the US or North America or developed market. Jenga did it on a global scale. And he found out that there were about 440 some companies that had become 10 baggers in the previous decade. Lo and behold, India had the highest number of 10 baggers. A few other companies, a few other countries were US, China, and Japan. And the more surprising one on the top 5 is actually Sweden. In any case, back to India, unlike many other emerging markets, the equity culture in India is very ingrained. India has the second oldest stock exchange in the world, has more than 5,000 stocks publicly traded. There's actually a good collection of high quality businesses. Late Charlie Munger used to say, go fish where the fish are. And I think India is a good place to fish for investment ideas. That's a little bit about the past. How about the present? Notwithstanding the recent tariff issues and H-1B visa issues, the macro picture is still very attractive. A lot of you know about the demographic profile. It now has more than 1.5 billion people. The median age of that 1.5 billion people is only 29 years. That's actually even lower than what it was during the Asian tiger economies of the 80s and 90s. It's got one of the fastest growing large economy in the most recent quarter that ended in June. GDP grew by 7.8% in India. Of course, that I expect that number to go down, given all the headwind, but still going to remain fairly healthy relative to most of the developed markets. Like the US, the local economy is driven by consumption, consumer-driven local economy. More than 60% of GDP is driven by local consumption. That's slightly different from many other emerging markets. But one of the most unique features about India is its digital infrastructure, particularly over the last 10 years. India has leapfrogged on that front and has stacked on a number of different applications, and they call it India Stack. One of them in particular is called UPI, Unified Payment Interface, through which more than 40% of India's GDP is transacted on a daily basis. This is essentially an application where payments from the consumer to the vendor can be done all through digital mode. You just flash a phone and transaction is completed. Actually, on a global scale, more than 50% of all digital transactions happen in India today. So while the current geopolitics has clouded the visibility a bit, I remain quite optimistic about the medium to long term. But what about the future? Some people have asked me if India is the next China. I'm not sure about that statement, although Jeff Gundlach, the founder of Double Line Capital, has said exactly that. But I have not spent time studying the China market. I'm not invested there. But given the current macro setup in India, it actually reminds me a little bit about what Robert Gordon said about the United States in 1870. This is a fabulous book where he wrote about the historical development of the United States, and he called it the year beginning in 1870 to 1970 as the special century. According to him, around 1870, what was just a collection of small towns and villages, as a result of intense networking of infrastructure, railroad, air, and even waterways, combined with some great inventions, led to the prosperity of the United States. When I go to India these days, India is just a large piece of construction site. There is infrastructure built out across various different areas. Rail network is about 43,000 miles. That's growing at 3,500 miles a year. Road network is growing at an even faster pace. Number of airports is expected to be about 220 by the end of the year. Now, the big bang in economic terms in India was in 1991. Right before the big bang, the number of planes flying the friendly skies of India was less than 100, less than 100. Today, there are more than 900 planes flying the friendly skies of India, dominated by a couple of big airlines, Indigo and Air India. Just recently, Indigo placed an order for more than 940 planes, essentially doubling the number of planes flying the skies today. Air India, on top of it, has placed an order for 500 planes. So this is just to give you an idea of what sort of growth is happening locally, even though the macro picture gets clouded by some of the more recent developments. One of the books that I'm currently reading is called Profit of Innovation. It's a biography on Joseph Schumpeter, the Austrian economist who coined the term creative destruction. He said, for a capitalist society, it needs to have three things: private ownership, check mark for India; entrepreneurship, a big check mark for India, more than 140 unicorns, about 12,000 plus startups focused just on AI. So that's a big check mark. And then the third and the most important criteria is the creation of credit. According to him, the core ethos of capitalism looks constantly ahead and relies on credit in launching new ventures. Creation of credit is an important factor. And that's actually a good segue into Bajaj Finance, which is the largest specialty finance or specialty lender in India. These are referred to as NBFCs, or non-bank financial companies. There are lots of them around, and Bajaj Finance is the largest of them. If I take a step back, the total credit in India is about $2 trillion, a little more than 2 trillion. That's growing at a healthy double-digit %. It's dominated mostly by the commercial banks, very small capital markets, debt capital markets available in India. But the other 22-23% is controlled by these NBFCs. Bajaj Finance has less than 2% of that total credit. So it's a highly fragmented market, a lot of room for Bajaj Finance to continue to grow, even at this pace. While the origin story of Bajaj Finance goes back to, I think, 1980s, the origin story of the current version of the story, goes back to the great financial crisis. Right when Lehman Brothers folded here, Bajaj Finance almost folded back in India. The two primary sources of trouble in a lender are credit, poor underwriting, and number two, capital, or more the lack of it. And those two factors came back to bite Bajaj Finance. That's when the current management team, the chairman Sanjeev Bajaj, the managing director Rajiv Jain, they all came together, a couple of other people who are no longer in the company, and set the path for the future. And today, as a result of that intense focus on credit quality, the company has less than 50 basis points in terms of poor credit, non-performing assets. It has a fortress balance sheet with capital north of 20%, which is more than 3 times that of a traditional bank, consistently generating more than 20% return on equity. All that, has essentially translated into the stock going up more than 300 times since 2010. So that's all in the past. How about the future? Well, I attended the Investor Day in Pune, India, which is on the western coast of India. The big focus is on AI. The management team and the board talked about the focus on transforming this financial services company into Fin AI. They claim that they have the largest or the highest number of AI professionals in the country. There's no way for me to verify that, but that's their claim. They currently have about 102 million customers. And the goal is to double that within the next few years, next 5 years, less than 5 years. My view is they'll probably double it way before that. And the company is controlled by the Bajaj family, which owns more than 50%. Sanjeev Bajaj, he's the son of the founder, one of the sons of the founder. He's the chairman of the board. He controls it through a couple of different vehicles, more than 50%. And Rajiv Jain, as I mentioned, is the managing director, who's essentially the CEO of the company. He's been with the company since 2005, but has been running it for more than 10 years. Good quality management team with fantastic capital deployment history. From a valuation standpoint, for a company that is growing at this incredible pace with a fortress balance sheet, run by good quality management team, it's trading at a reasonable valuation, even though it looks like it's in the mid to high 20 times earnings. I still think it's a very reasonable valuation for this quality business. So that's my spiel on Bajaj Finance in India. But before I wrap up, let me share a couple of pictures that I took during this trip. This is a picture of a house in Chennai, which is in South India, my home base. These two are the pictures of the same house. One on the right is a little bit more zoomed in, showing some of the swanky cars parked right in front. I'll tell you more about this if there are more questions later on, but it shows you the complex contradiction in India. Extreme wealth sort of juxtaposes right next to absolute penury. Here's a couple of pictures from Delhi. I was visiting Delhi to meet with a couple of management teams. The one on the left is a picture of Red Fort, which is the old Mughal palace. It was the epicenter of the Mughal Empire for more than 200 plus years. And that's in the background. And in the foreground is, again, abject poverty. On the right is a street that is in the neighborhood of this Red Fort, shows you some of the old part of Delhi. So the point is, it's a country with full of contradictions. And from my viewpoint, as a global investor, I remain very optimistic about the medium to long term. And as such, about 20+% is invested there. And I'm working on a few more opportunities, and it's likely to increase from here. And the final point is, some have even asked me if this portfolio would become all India. Absolutely not. This is just a global portfolio within which India has become the second largest exposure. US is the biggest. India has become the second largest. And given the opportunity set, I remain very optimistic. So with that, let me end the presentation and hand it back to Jessica.
Sounds great. Thanks, Shree. Just to reiterate that we're happy to take some questions in the chat. I see some coming in, and we did have a couple that came in offline as well. So I'll give people a moment to submit some in the chat and go ahead and address some of the offline questions. Shree, can you talk a little bit about the tariff situation and how SVN is positioned to handle the impact of tariffs?
Sure. As I mentioned, India particularly is taking it on the chin, but I guess the question is more widespread. Going back to Liberation Day, what happened at that point was absolute uncertainty. The market can generally price risk, but struggles to price uncertainty. And that's the reason why, not just here, but globally, the markets went down quite significantly right after Liberation Day. But as we have seen over the last few months, many countries have kind of come here and signed up some palatable agreement with this administration. And as a result, there's been a little bit more clarity on uncertainty. And as such, markets have continued to improve. With India, it's a slightly different story. It's still an ongoing struggle. For those that are not aware of this, there's a 25% tariff that was slapped on India along with the rest of the Asian countries. And because India was purchasing oil from Russia, there was another 25% that was slapped. That went into effect in late August. Fortunately, the Commerce Minister from India is in the US and has been saying that we will arrive at a solution way before November, and it will be palatable for both sides, apparently. That's as far as India is concerned. From our businesses standpoint, there are, again, they went through the same process of not being sure as to how to price this, and have gotten to a point where they're now able to price their products or services. And specifically, some of the products that are, from India standpoint, clothing, jewelry, and a few others have been impacted quite significantly, while many others are still waiting for more clarity. As such, the portfolio is a little more than 50+% exposed to the US. And even though those businesses were also hurt right after Liberation Day, many of them have seen improvement in the operational performance. And that's the primary focus that I eventually go to. How are these businesses performing operationally? If I looked at the most recent quarter, out of the 11 businesses, only one actually announced slightly weaker performance, and that happened to be an India business. Most of the others were essentially saying it was operating performance was actually holding up well and improving, although the stock performance itself was not necessarily in alignment. So there is more clarity coming, and as more clarity comes in, I'm absolutely certain some of these management teams will become more optimistic.
Great. We actually had a four-parter come in, so I'll give you the first two and then follow up. But any overview on why the Indian market has not moved, and how will Q2 earnings play out? And then actually, I'll mention the third and fourth. So Azad Engineering won a contract from Mitsubishi. How is Triveni placed for Q2? And are there any other opportunities in India other than the four portfolio companies we currently have in the SVN portfolio?
Yeah. And maybe I will start with that second question, or the second of the four-parter. Yeah, the turbine business is actually doing exceptionally well. Triveni Turbine is actually the one company that had a weaker announcement. Just as a background, Triveni Turbine is an India-based company that manufactures steam turbines. The input is anything from wood to natural gas to any kind of a source. The output is industrial strength steam, and they specifically are the market leaders in the 30 megawatts and below size range. It is the second largest turbine manufacturer in the world, second only to Siemens. And in the quarter, the operating performance was a little weak, only because right before the quarter ended, there was a 12-day war with Pakistan, and that hampered travel to India. And many developed countries actually announced India to be a non-travel zone. The way Triveni books its revenue is, it takes about 6 to 9 months to complete a turbine. And it has customers both inside, and about 50% of its business is export. People coming from East Asia, Middle East, North America, and particularly the non-India customer base reduced its travel, or at least stopped its travel during that period and a few weeks after that. And the way Triveni books its revenue is the customer will have to visit its plant in Bangalore, view the turbine, approve it for delivery, and that's when the company will book its full revenue. But it also, Triveni's operation is also based on collecting an upfront 15% deposit, and then getting money delivered to them along the process, along the 6 to 9 month period. So almost all these people that deferred their travel, they had actually given up 85% of the actual purchase of the turbine upfronts, and so they were not going to cancel it. The whole thing got pushed into the second half. And I expect the next 2 quarters to be fairly strong within Triveni. So that's the Triveni specific answer. And now I forgot the first part of the question. Jesse, do you mind repeating that?
Sure thing. Any overview on why the Indian market has not moved?
Yes. So, as I mentioned up front, this tariff has been a big driver. Slapping an additional 25% has been another headwind. The war with Pakistan was again, anytime there is uncertainty, the market goes down. The war with Pakistan was another factor that had an impact in the earlier part of the year. But all that is near-term, I would say near-term cloud that impairs the visibility of the market. Medium to longer term, I expect already the war with Pakistan is over. There is more talk about the tariff settling more favorably to both sides. And the dynamic within India is that more than 60% of the Indian GDP is driven by local consumption. And that's expected to go up over time. So medium to longer term, I expect that number to be the primary driver. It is, as I said, the fastest growing large economy in the world. And even though the headwinds are fairly intense, I still expect the GDP growth to be relatively high. And the businesses that I have, 4 of them, 2 of them are India focused, and 2 others have about 50% export business. All of them I expect over time to benefit from the consumer demand. And so I remain quite optimistic.
Great. So one last question on the India portfolio,
Sure.
just from those that have come in, but just wanted to share from Lalit that he's currently in India. He agrees with the contradictions of life of rich and poor altogether. Spent a week in Bangalore and now back in Mumbai. Feeling great, vibrant energy on the ground based on my travel and meetings with new founders. So his question is related to Tata Finance, TATA Finance, and the IPO coming soon to market. Not sure if you have any thoughts or are analyzing with regards to Bajaj.
Yeah, I've looked at that. And by the way, NBFCs, or the specialty finance, non-bank financial companies, there are many hundreds of them. Tata, and in fact, Jio, part of the Reliance Group, is another one that's in the space. These are big players, and there are a number of smaller players. But I look for, what I'm looking for is really high quality. And I want, what I look for is historical performance. As I showed, Bajaj Finance's operating performance has been absolutely astounding since its stumble in 2007-8. I look for the quality of the management teams. Rajiv Jain and his team at Bajaj have done an excellent job of thinking about capital deployment and the work culture. I haven't had the chance to meet either the Geo team or the Tata team, but I've had the chance to meet with Bajaj Finance and a few other businesses, of course. But the work culture within Bajaj Finance is absolutely astounding. This is a country where people generally go to work around 10 o'clock in the morning. And that's the typical practice. They also end late. But Bajaj Finance, under the guidance of Rajiv Jain, has a work culture that's very different, even relative to one of its sister concerns. Bajaj is a big conglomerate. Back in the days when the father, Rahul Bajaj, split the two companies, Bajaj Finance and Bajaj Auto, and gave it to two sons, Sanjeev Bajaj running Bajaj Finance and his brother running Bajaj Auto, both in Pune on two different ends of the city. Rajiv Jain has brought in a culture of a work ethic that is very different. That's very reminiscent of what happens in the Western world. He starts work at 7:30 in the morning, and everybody's out there at 7:30. While visiting Bajaj Finance, I stayed with my nephew. He works for Bajaj Auto. I specifically asked him about the work ethic and the culture within the organization. It's very different. It's typical India-style work ethic. Nothing wrong. It's just that I find this to be quite appealing. And this is a gentleman that has inculcated that Western ethos and the work ethic in a way that has been long enduring. And of course, people work hard, and the compensation structure is also tied to the performance and the quality of output. And so that's a very different kind of culture within that organization. And that's why I have preferred Bajaj Finance over many others.
Great. Thanks for the question. Okay. So kind of moving from the India portfolio specifically, we did have quite a few questions coming in wanting your thoughts on AI and the prevalence of it right now. So how is SVN positioned to handle any impact from AI?
Yeah, that is the rage at this point. Not just in the US. I'm seeing that in India and many other European countries as well. That is the rage. And in fact, if we looked at S&P 500, it's dominated by these AI-driven names. Just a few days ago, just a couple of weeks ago, Constellation Software, which is a Canadian company, the CEO, the founder of Constellation Software, Mark Leonard, he held a call along with a few of his team members just to address this question. Constellation Software is a collection of vertical management software companies, VMS software companies, both in North America as well as in Europe. And so this is an important question that had been coming up. And so he held this an hour and a half long call trying to answer what the impact of that is on his businesses and generally on the larger market. He started off with a story about the founder of AI calling out back in 2015 the business of radiology. Apparently, the founder of AI back in 2015 had said, radiology as a business is going to go away. And he was encouraging radiologists at that time to look for something else. And he also said, for people thinking about entering this business, don't. it's almost 10 years since he made that pronouncement. Radiology as a business has thrived. It's not just survived, but thrived. The number of people practicing it has actually grown at a pace that's higher than the population growth. So his point is, obviously, even the founder of AI had it wrong as far as his pronouncement is concerned. And that's sort of at the end of the call, what I walked away with was, this is something that is new, that is impacting a lot of different areas. Lots of people are benefiting out of it. It is too early to tell who the eventual big beneficiaries are going to be. In fact, soon after that, unfortunately, Mark Leonard had to step down. That's a different part of the story. But soon after this call, a gentleman by the name of Jerry Newman wrote this fascinating article on Colossus called, and he titled it, "AI is Not Going to Make You Rich." It's a long article. I would encourage people to read it. Maybe Jessica can include it as a part of the follow-up email. And in it, he says, whenever a new thing shows up, you need to ask two questions. One is, what is the value add out of this new thing? And number two is, who's going to capture that value add? It gives a lot of different examples, beginning with containerization. Shipping businesses and container businesses did not capture that. It was actually the retailers like Walmart and IKEA that captured it. And he goes on to give a number of different examples. And eventually he concludes saying, from his standpoint, most likely the healthcare and financial services companies and many other end customers are going to be capturing the value of this AI. And only time will tell, but lots of different moving parts at this point. I would say from our standpoint, some of the businesses that we own, Bajaj Finance in India, for example, KKR, a private equity firm, which is investing in across a variety of different areas, is one that is playing in, data centers and other AI-related investments. Copart, which is a salvage yard company, has already started talking about AI and the use of AI in its yard operations. So it's these end customers that are beginning to talk about the deployment of AI and the impact. From my standpoint, I'm not intelligent enough to think about the current AI AI capital spenders like NVIDIA and a few other big names, and so I'm staying away from those. But only time will tell as to who the eventual value capturer of this is going to be.
Staying on AI, do you have an opinion on Kinsale's technology moat with AI as a threat or opportunity? And just a piggyback on that, what do you think of the short report that came out about Kinsale?
Yeah. So for those that do not know, Kinsale Capital is a small insurance company. It focuses on what is called as excess and surplus. Essentially, these are specialty insurance products that are not typically available through standard underwriters like State Farm or Allstate and a few others, and many others. So this excess and surplus, or ENS, is a subset of the larger property casualty market. It's about 120, 130 billion in total size. It's growing at a rapid clip. And actually, Berkshire Hathaway is the largest excess and surplus writer. AIG, Fairfax out of Canada, and a few others are way ahead in terms of market share relative to Kinsale. So Kinsale has a unique approach to this excess and surplus market. They run the business out of just one office in Richmond, Virginia, and all its 600 some employees come to the office every single day. In fact, the CEO, Mike Kehoe, required the employees to show up at the office even during COVID. Of course, distanced very appropriately, but people had to show up in the office at that time. So it's one office helping the company keep the expense ratio down, the cost basis down. The other important driver for the company has been the use of its technology applications. It has been developing its own in-house technology, which helps capture many of the factors that are needed to underwrite an insurance policy. And they have certain specific guidelines as to what sort of risk to take in which region and which product line and things like that. That also helps them cut down the expense ratio. And as such, for an insurance company that is in this specialty insurance area, it has an expense ratio of about 20 to 21, 22%. That relative to the larger industry operating at 35, 36%. There are many others that are even well north of that. In the insurance space, two factors add up to the total expense ratio. One is the actual expense itself, and the other one is the loss ratio that the company incurs as a result of underwriting. The combination of those two is called combined ratio. Anytime an insurance company can write at a combined ratio that's less than 100%, it's supposed to be underwriting at a profit. Anything over 100% is underwriting at a loss. There are many P&C companies that are underwriting at over 100. The average combined ratio at Kinsale has been in the high 70s to low 80%. It continues to be so. And so there was this short report, more a video update of a short report. The gentleman went on a show with Steve Eisman. Steve Eisman was a big financial services investor back in the GFC days, great financial crisis days. He's conducting a podcast, and he had this gentleman jump on and participate in that. He makes some forceful accusations about the company. At the end of the day, insurance is a business where you have to make a leap of faith. This is one unique industry or product where the company will not know the cost of goods sold at the point of sale, because it's the nature of this underwriting process. Risks show up over a period of time, and so the cost of goods sold will become evident only over a stretch of time. For me, I view this management team. I've met the management team many times. Mike Kehoe is the founder, and he's the largest shareholder. Has pretty much all his net worth tied up in the company. Has grown the company from a standing start in 2010 to what it is today, more than $10 billion in market cap. Because of the nature of this business, the E&S is a very unique aspect of it. And the way Kinsale operates, it excludes many risks that it is not willing to take on. So, for example, if there is an apartment complex in Atlanta, Georgia, I'm just picking a name and a location, the company may say in its policy that firearms are not allowed to be brought into this building, and say there is a shootout in the building. And if there is injury or death that happens as a result of that shootout, Kinsale would go back and say that was not included as a part of its policy. And the claimant may say, eventually there was damage, and so it has to be claimed. So it eventually goes to the court, and that's where it gets settled. So this is the nature of how Kinsale takes its risks, limits its risks by specific items, which is generally not the case in many other businesses. And this gentleman who was on the call highlighted some of these as big negatives. I view this as a part of business. This is a business where there are two brokers involved, a wholesale broker who actually brings the business to Kinsale, and a retail broker who actually brings it to the wholesale. eventually it gets to the consumer. So those two parties are also responsible in explaining the nuances of the policy to the end customer. So long story short, yes, there are some worthwhile points that he makes, but I remain clear in my analysis. I've had several conversations with the management team. The nature of the business has not changed, and so I'm still invested in.
Great. We had a few questions come in about former holdings, Shree. Specifically, if you could give your thoughts on why you sold the positions in Evolution and Old Dominion, ODFL, and certainly kind of giving where they are today. If you could speak to your thoughts there.
Sure. Good question. I actually maintain a database on my own computer about some of the previous positions. It is to kind of keep me informed about why I made certain decisions, how not to make similar type of mistakes in the future. Not all of them were mistakes. Some of them were decisions based on the new opportunities being more attractive. But let's start with Evolution. This is an online gaming company based out of Sweden, a fabulous business, fantastic returns, fantastic growth opportunities. It has a growing presence in the United States, although the number of new states that have opened up for online gaming has been stagnant over the last few years. But it's online gaming instead of going to a physical Hard Rock Cafe or a Bellagio or any type of physical structure. People can kick back and play many of these games right from their living room and office room. And so it's a fantastic alternative to the physical infrastructure. They offer most of these games through a few different locations. A large chunk of them are based in Georgia, the country, in Eastern Europe. And there are many other studios. They call them studios where they host these games. Young guys and gals sit in front of a computer like this and present the games. They have a large presence in the country of Georgia. Couple of years ago, there was a big strike out of Georgia that was initially supposed to be just a handful of people that grew into a much larger employee base. That by itself was a factor, but that by itself was not the primary factor. Number of different factors added to my decision. They have a growing presence in Asia. Asia is a big chunk of the larger pool of their money, of their business. Big chunk of that is coming from Asia, but unfortunately, for competitive reasons and for other operational reasons, they have decided not to disclose the type of countries that business is coming from. Now they don't have a physical presence there. It's all done through what are called as aggregators who are operating in Europe. The aggregators bring in these operators from Asia, and as such, they have this growing presence there. And so, as the business from Asia continued to grow, I wanted to know more about the specific risk of that revenue coming from countries like, China or Japan, South Korea. And so that continues to remain an enigma. The company still doesn't want to disclose that. It continues to remain an enigma. I love the management team. I've gotten to know them personally. But because of all those factors, I decided the risk was a little bit too much than what I wanted to take on. And at the same time, that's when the India approval came in. India names started growing within the portfolio. So I switched part of the capital, a big chunk of the capital from Evolution into the India portfolio. That's on Evolution. Old Dominion, it's what is called as LTL, less than truckload trucking company. Again, there are hundreds of them, half a dozen of them essentially control the market. They're big trucking businesses, shipping stuff from one end of the country to the other. They have a unique approach relative to the truckload business, where one can start from New York and end up in San Diego, not in one go. It may take a few days, but in one go they will ship from New York to San Diego, as opposed to less than truckload, where they will have a number of different stopping points and moving the freight from one place, one truck to the other. It's a fabulous business, been around since the 50s. The founding family had been running the company right up until the middle of the 2020s, or 2010s rather. And we now have the second CEO, Kevin Freeman, who's not a family member, who's been with the company for 30 plus years, who's running the company. The Congdons, who founded the company, a couple of them are on the board. But the business has continued to see increased competition. FedEx Freight is the one recent big name that is likely going public soon. In addition to FedEx Freight, a number of other players have come in, and the competition has gone up, while at the same time, freight volume itself has gone down. Again, non-family member running it, it's not a negative, but as I mentioned up front in my investment objective, I look for skin in the game. I look for good quality management teams, but I look for skin in the game. And again, I considered that relative to some of the other alternatives that were available for me, took the capital out to deploy it elsewhere.
Great. I think we have time for just one last question, and
Sure.
had a couple that came in regarding Copart, and wanted to get your thoughts on the your thesis, and specifically you've discussed the life cycle or the life of a vehicle to be approximately 12 years, meaning there are many years of runway left for Copart to continue growing their revenue. Now, with so many autonomous players coming into the market, is your thesis still intact? If you can just expound on that a little.
Absolutely. Yeah, Copart is a core part of the portfolio. I added it to the portfolio right around COVID in 2020. This is the largest salvage yard company in the country. But essentially, it's an oligopoly between Copart and IAA, which is actually a Chicago-based company, was acquired by Ritchie Brothers, which used to do primarily large farming and earth-moving equipment resale. And so these are still the two big players in the business. Copart has somewhere around 65% market share. Nobody really knows the exact number, but it's somewhere in the 60s, while the rest is with IAA. Going back to 2016, for example, that's when Copart, kind of came at it with a lot more focus. The number of catastrophe. So let me actually take a step back. So the business is actually a marketplace where Copart, or IAA for that matter, gets paid from both the seller and the buyer. Seller in this case is insurance companies. All these policy holders, when they meet with an accident or something happens to the vehicle, they need the vehicle to be removed, and taken care of immediately. At least that's the practice in the US. In Europe, it's slightly different, but predominantly 80% of the business is still the US business. So they get paid from insurance company to take care of these vehicles immediately. And then these vehicles are purchased by repair shops, people who want to fix their vehicles or even resell them. A number of different types of buyers on the other end. Copart has a large base of buyers, both in the US and particularly non-US countries in Africa, South America. Now, your vehicle may be not in drivable condition here in the US, but once it gets to, say, Guatemala or Chad in Africa, there are people who can repair these vehicles and drive it for a number of years later on. So the buyer base is fairly large, and that's the nature of the business. Why do vehicles get damaged? Well, it can be accidents or it can be just wear and tear, and sometimes it's Mother Nature. You had Katrina in Louisiana that damaged a number of different vehicles. Copart was able to move in and remove these from the site and take care of them pretty quickly. And that's what was happening consistently. And in 2016, Copart kind of applied a lot more focus to addressing the primary seller base for Copart, which is the insurance companies. The top 25 insurance companies essentially have either sole contract with one of the two, or most of the time they split it between Copart and IAA. And Copart wanted to take care of these insurance clients real quick, and so they ended up spending a lot of capital in getting tow trucks to pull these vehicles out of these damage zones, catastrophe zones. And they've been gathering market share as a result quite consistently. Unofficially, I think Geico has a big chunk of its business going to Copart, and Progressive has a big chunk of its business going to IAA. And so that's the setup today. There are a couple of RFPs. Apparently, there are a couple of RFPs outstanding today. One is from Progressive, which is the fastest growing auto insurer in the country. About 85% of its vehicles go to IAA. And just as a result of Progressive growing at a rapid clip, IAA's volume is growing. Now, as a result of this acquisition by Ritchie Brothers, IAA has been able to get a new tailwind back to its business. It used to be part of a much troubled parent, essentially was forced to sell, and Ritchie Brothers acquired them. And since then, they've been able to come at this with a lot more focus. The management team, the quality of the team has improved. The acreage, the land that is available for IAA to pick these vehicles and store them until they're eventually serviced and sold, that land has increased as a result of Ritchie Brothers' land ownership. That was a big difference between Copart and IAA before Ritchie Brothers acquired them. And so there's been consistent improvement in IAA's operating performance as a result. The fear today is IAA going to grab a lot more market share and essentially displace the number one position that Copart has? I doubt if that's going to happen. I think insurance companies want to have a balance in who they send their vehicles to. So I'm sure there is some market share moving between Copart and IAA, but it's going to settle down within a reasonable period of time. And in the meantime, Copart itself has continued to grow. It's not necessarily sitting idle. Copart has continued to grow its land base. It has more than 19,000 acres of land spread across the country, around the world, actually. It has a big growing business in UK and in Germany. The number of vehicles coming into the system continues to remain robust. 360 some million vehicles in the car park. About 13 to 15 million vehicles come into the system every year. That's actually slightly lower than what it used to be. I think we hit something around 18, 19 million vehicles per year a few years ago. But the quality of the vehicles have improved. That's one reason why the age of the vehicles on the road has gone up. It used to be high single digits. It's now almost 12 years. And also, buyers of new vehicles find the current interest rate environment to be slightly high, and that has had an impact on new purchases. But the age of the vehicle, the quality of the vehicle, all that is leading to that. Is AI going to change all this? Over time, I'm sure the number of vehicles coming in will be impacted by AI. But even if we take this 15 million vehicles, there's about 5 million that actually get removed from the system every year as a result of accidents and wear and tear. It'll take a long time for the entire volume to be replaced by AI. I was reading this somewhere where it said anytime a new technology comes in, it takes anywhere from 30 to 35 years for that to become more prevalent. So AI, the autonomous vehicle is definitely a feature today, but it'll take a long time for that to replace the existing type of vehicles on the road.
Wonderful. Well, Shree, that does it. We have exceeded the hour mark here. Great questions. Really enjoyed the engagement. Thank you to all of you who joined. And looking forward to doing this again soon. For those of you that we weren't able to get to your questions, I'm happy to follow up and see if there might be an appropriate time to connect. But look forward to doing this again. Shree, thank you for your thoughts. And attendees, thank you so much for joining us this morning.
I sincerely appreciate all of you taking the time. A good India goodbye. Thank you.